You know those moments when price pushes too far too quickly and then snaps back like a stretched rubber band? You think you missed the move, but then the market pulls up and drifts back towards its average. That move back toward normal is called mean reversion. Today we're going to use a tool that turns that concept into something visual and actionable. Mean Reversion Probability Zones by Big Beluga. It doesn't guess, it measures when price is statically stretched and shows you where a snapback is likely to happen. We're building this on TradingView, which is the platform I'm using in this video. If you haven't signed up yet and want to follow this exact setup step by step, there's a link down in the description. Start with a clean chart on any market and any time frame you prefer. I'll use the 1 hour chart so everything is easy to see. Open the indicators menu, type Mean Reversion Probability Zones by, of course, Big Beluga. Big shout out to them, by the way. Then add it to your chart. It's an open source script, so if you're curious, you can read the code and the full explanation on its TradingView page to understand how it works under the hood. Once it loads, the chart tells a very simple story. Behind the scenes, the indicator reads an oscillator, RSI, MFI or stochastic, and then converts those readings into probabilities that price will revert back towards its mean. It displays this information in 3 different ways at the same time. First, you'll notice histograms attached to the oscillator pane. The upper histogram represents the probability of price moving down toward the mean. The lower histogram represents the probability of price moving up. Second, the indicator draws semi-transparent zones directly on your price chart whenever mean reversion odds are elevated. Third, there's a small dashboard in the corner that tracks recent maximum probabilities in each direction, helping you see whether the current reading is extreme or just normal background noise. When you put it all together, the chart stops being a guessing game. You can see stretch, direction, and context all at once. Let's quickly name the main components so you can read them fast. The oscillator choice is up to you. The script lets you switch between RSI, MFI, and stochastic. If you like familiar behavior and clean signals, RSI is a strong default. MFI includes volume, which some traders prefer on assets that show momentum without real volume backing it up. Stochastic reacts faster and can work well on choppy, mean reverting markets. You're not locked into one choice. You can test each option on your market and pick what fits your eye best. Now look at the histograms near the oscillator. When the upper histogram starts growing, the tool is telling you conditions favor a downward snapback. When the lower histogram builds, it says the odds of a bounce higher are increasing. These bars don't replace your judgment. They frame it using actual probabilities. If the number is small, you know the stretch isn't meaningful. If it's large and near or beyond the recent maximum shown on the dashboard, you know you're in rare territory. That's when you slow down, mark the level, and wait for the price action to confirm it. On the main chart, those shaded probability zones mark the areas when mean reversion is most likely to begin. This is where the tool really shines because it connects the math directly to the price level you're actually trading. If price pushes into a support area while the lower histogram spikes and the chart fades that zone, you have a clear place to plan your entry, your stop, and your first target. The same logic applies at resistance. When the upper histogram fires, the zones keep you from fading too early in the middle of nowhere. Before trading with it, let's adjust the settings so the tool matches your trading speed. Start with the oscillator selection. Try RSI first. If your chart is very spiky, switch to stochastic for faster reactions. If you want volume awareness, test MFI. Next, set your upper and lower thresholds. These levels tell the script where stretched the conditions begin. On RSI, common starting values are 70 on top and 30 on bottom. You can keep those on day one and adjust later as you learn how your assets behave. Higher thresholds will trigger more often. Wider thresholds will trigger less frequently, but the signals are usually stronger when they do. You can also choose the colors for upward and downward probabilities and decide when to show numeric labels on the histogram. I like keeping the percentages visible because they help ground your perception when a spike looks huge but only prints a mid-range number. Finally, keep the shaded zones enabled on the main chart. They're the bridge between the math in the sub pane and the actual price level you trade from. The dashboard can be moved or minimized, but I recommend keeping it visible at first. It's an excellent speedometer for letting what high probability really looks like on your market. Now it's time to trade. Plan is to combine a strong probability spike with the structure you already trust. Then wait for a clean reversal signal. For long setups, I want to see lower histogram spike while price leans into support. That could be a prior demand zone, a moving average I respect, or VWAP on intraday charts. If the shaded zone wraps that area and the dashboard shows recent upward probability readings are elevated, I go on watch. I don't buy the first green doji. I wait for confirmation. A bullish engulfing off the level, a spring that dips below and snaps back, or a strong close reclaiming the zone. Those are my green lights. Entries are taken on the close or the first small pullback, depending on your style. The stop goes just below the structure. The first target is conservative, usually somewhere between 1.2 and 1.5 risk-to-reward ratio, so the statistics can work in your favor. If price continues moving toward the mean reversion or the mid-channel on your system, trade a runner and let it work. The tool itself recommends pairing these probabilities with support and resistance or a trend filter to avoid fading strong trends. That's exactly how we're using it here. For short setups, just flip the logic. I want the upper histogram to spike while price pushes into resistance. If the chart shades that band and the dashboard shows recent downward probability extremes, I wait for a clean rejection, a bearish engulfing back below the level, a failed breakout that snaps back, or strong close under the zone. Those are my triggers. The stop goes above the wick. The first target is again around 1.2 to 1.5 risk-to-reward ratio. If the move extends and follows through appears, you trade the rest. If buyers reclaim the level, you exit. Simple rules, no hero trades. A few small habits can noticeably improve your result. Always read the histogram in the context of the dashboard's recent maximum values. A 40% up reversion might be huge if your market rarely exceeds 45%. But if you just saw 80% readings last week, that same 40% is just average noise. Also, respect slope. If the oscillator is still aggressively moving upward while the upper histogram is only starting to rise, Give it time. Let price actually reach the level you care about instead of stepping in early and fighting trend momentum. Mean reversion can work in trending markets, but you need faster profit taking against the dominant move. That's where disciplined targets and stop placement protect you. One thing I really like about this script is how clean it keeps the chart. Many tools overload you with lines. This one shows intent exactly where it matters. The histograms show directional odds. The shaded zones map that math onto tradable price levels. The dashboard tells you whether today's reading is normal or truly rare. Add your own structure and a basic reversal pattern. And you have a clear, repeatable process for entering, managing risk, and scaling out. That's what the trading needs: clarity. If you like digging under the hood, remember this is an open source script on TradingView. You can see how it checks whether the oscillator is rising or falling, whether it's above or below your thresholds, and how far price is from equilibrium. It blends all of that into a probability model, then paints the outputs you see on the chart. Upper histogram for downside reversion probability, lower histogram for upside reversion, and the small dashboard that tracks recent extremes. The written explanations break it down in the plain language, and it's worth reading even if you never touch the code. Let's wrap this entire approach into a sentence so you can remember it easily. Combine a strong probability spike with a real price level. Wait for a clean reversal candle, place your stop beyond the structure, take first target near 1.2 to 1.5 risk to reward ratio, and only trail if momentum supports it. Repeat that process and you'll stop chasing every wiggle and start focusing on stretches that actually have meaningful odds behind them. This is not a financial advice though. Everything here is for educational purposes only. Trade a position size that fits your risk tolerance. Build a complete plan for entries, stops, and exits, and double-check your thesis before clicking buy or sell. Backtest these rules on your markets. Forward test with small size and only scale when your stats justify it. If you found value in this breakdown, hit like. And if you want more clean, testable tools like this, consider subscribing and turning on the notification bell so you don't miss the next video. Thanks for watching, and see you next time.